It's the Real Estate Podcast, across every state, city and town of Australia.
And welcome to another episode of the Real Estate Podcast, available on iHeartRadio every morning, also on Spotify and Apple and wherever you get your podcast from. Well, the weekend is back. Yes, the first weekend for August, the 6th day for 2022. And coming up this morning, we're going to be talking shortly with Carlos Cacho, everything from mortgage buffers to mortgage defaults, bank serviceability of mortgages being eroded, and a whole lot more. If you're celebrating a birthday for today, the 6th of August, have a great Saturday, have a great weekend. You share it on the same day as Andy Warhol. Well, that's if Andy was still alive, of course. He's not. He was born on this day back in 1928. And checking on the history books, unfortunately, a very infamous day on this day in 1945. In one of only two times nuclear weapons have been used in warfare, the United States drops a nuclear bomb on the industrial city of Hiroshima in Japan. Over 150,000 people were killed. And after the Hiroshima and Nagasaki bombings 3 days later, Japan surrenders to the Allies, and that ended the Pacific War. And on a brighter note, coming up next, we'll have a look at your weather around Australia.
It's your weekend real estate breakfast, a serial-sized podcast about what's happening in your local backyard every Saturday morning on the Real Estate Podcast. It's the Main Centre forecast with propertybuyer.com.au.
And good morning if you're in Sydney this morning, expecting a fine day with sunshine and 20 degrees. Melbourne, a few more showers, not a bad temperature with 15. Brisbane expects some morning rain and 25 degrees is your forecast high. And in Perth, the showers increasing today and your high of 18 degrees.
We're just as addicted to property as you are. Every weekday morning from 6:30.
Well, it seems like we have had a very busy, long week, and thankfully the weekend has arrived. The rate increased, of course, on Tuesday, and since then, so many talking points regarding when are we likely to be coming out of what is a very uncertain time in the housing property market. Of course, the answer to that is just as uncertain as the question itself. Well, on this Saturday morning, let's bring in Carlos Cacho, Australian Chief Economist and banks analyst at Jarden. And a very good morning to you, Carlos.
Thanks for having me.
And yeah, it does seem like a lot has been happening. There's been a lot of talk around people having these buffers, and it's talked about like it's a widespread phenomenon throughout the country with people who have mortgages. They've got all this buffering behind them. The RBA have talked about the buffers. Inflation is the other driver, of course, coupled with mortgage rate increases. People are in mortgage stress right now. Just how bad is that situation, do you think, likely to get with the buffers that they're claiming that are there versus people that are running out of money?
Look, it's a very tough question. I think the challenge is, while in aggregate we've got these really big buffers, we estimate between extra mortgage repayments and extra deposits that people have put in banks since COVID kicked off, there's over $300 billion in kind of excess savings or buffers sitting there. The problem is we don't know where those sit. We don't know, how well equally distributed they are across the economy. And what we don't have data for this, but what I suspect is that a lot of those are sitting with probably a relatively smaller portion of households. We also know from the banks, from the own data that they've reported over the last 6 months, that there's about a third of customers who are 2 years ahead in repayments. And that's great. Obviously those customers are going to be in a much better place to deal with higher rates. But there's also over a third of customers who are less than a month ahead in repayments. And so they're obviously going to be feeling the pinch from higher rates much, much quicker. In most cases, they're going to be feeling it all right away, and they're going to be seeing their bank accounts now. And while some of those customers are, they've got a reason for not being ahead, they might have an investment loan, so there's an incentive to not prepay. They might be in a fixed loan where there's, not an ability to prepay, but there's still about half of them who are not fixed or who are not investors, who are not ahead on repayments. And so they're the ones that we worry about, where this pressure of rising rates is really going to hit their household budgets very quickly and quite hard given the pace of rate hikes that we're seeing come through at the moment.
And just having a look at that one step further, particularly around the repayments and the savings, of course, banks have the serviceability. And right now, that's being pretty much eroded, isn't it?
Yeah, absolutely. So APRA, the banking regulator, requires banks to assess a customer's ability to repay a loan at a higher rate than the loan will actually be at. So until October last year, that rate was about 2.5%. Now it's 3%, which means if you're getting a loan with a rate of 3%, the bank will check that you can repay that at 6%. The problem is that we're actually seeing, rates are probably going to be 2.5% or 3% by the end of this year, the cash rate, that is. And so that's going to mean that entire serviceability buffer, it's called, is going to be eroded by the end of this year. So instead of having that flexibility that banks have built into the calculation, what it could mean for some households is they actually need to cut down their spending towards the level where they told the banks they were spending. And I'm sure a lot of the listeners might be familiar with this. Often, when you get a loan, you don't add up every single dollar that you actually spend, an average week, but you make some assessments and, maybe some weeks you spend a bit more on dining out or doing something special, but on average you don't. And so what you're telling the bank you spend is a little bit lower than what you really do spend, in reality. And the challenge that represents is people are going to have to cut back their spending to be that, in a lot of cases, to be that lower level that they actually reported to the banks to meet those repayments.
Yeah, and having a look at the mortgage default rates, they're starting to rise at the moment. I guess a question here is, and it's a pretty serious one, where do you see that going in the next 12 months?
Look, yeah, they are starting to creep up a little bit, but it is important to remember we're coming off very, very low levels. Part of the rise is, some of these deferrals through COVID coming off for people who maybe, didn't recover as strongly as others. We do expect, in general, kind of bad debts or loan defaults to pick up over the next 2 years, but we kind of expect it to rise around about to average levels. So at the moment, if you look across the banks, their bad debts are around about 0.02% of total loans, plus or minus. So some of them actually still have negative bad debt provisions because they're able to offset the fat that they built in during COVID. We see that going up to about 0.2%. So it is going to increase by around 10 times, but that's still a fairly low level. I think the important thing to remember when it comes to mortgage defaults is that you really need unemployment to rise to see that rise materially. What we usually see as the driver of loans going bad is it's a significant change in circumstances. It's unemployment. It's a death in the family. It's a severe illness. It's something which affects your ability to earn an income, and just potentially having your value of your house go down significantly, which is likely ahead with rising rates, isn't usually enough to see people default in their loans. And historically, what we've seen in Australia is people have been pretty good at tightening their belts and keeping on paying the mortgage in rising rate or kind of more challenging economic environments. So we do generally expect that mortgage holders are going to make their repayments. It's probably going to mean that they have to cut back in other areas, but we do expect most people will be able to make it through.
And coming back to the banks, what realistically can the banks do to offset potentially a lot of people losing their homes? Now, we are constantly reminded this is a unique set of circumstances for the pandemic that we are all living through. And just last night, I was watching a 60-minute story about young teenage girls getting tics out of the blue. It's a new phenomenon. It's because of the pandemic. So my point is that these are unpredictable times. Therefore, is there a plan that banks could implement? Could they turn to something and think outside the box?
Look, I think they don't necessarily need to think outside the box. We've come through COVID over the last 2 years. And what we saw there is, the banks really came together as an industry, Team Australia, as we kind of colloquially started calling it. And they offered these repayment deferrals. They offered holidays. They made it much easier for households who are impacted to to not fall behind too bad on their mortgage or to not risk losing their homes. Really, the last thing the banks want is widespread mortgage defaults that lead to foreclosures and forced sales. Because what we've seen in previous financial crises globally is that when that happens, the outcomes are a lot worse. It takes a lot longer to recover, and the realised losses you get on those assets are going to be worse. If you have a lot of people who are forced to sell their home, the prices are going to drop further, as opposed to if you can help people get through a challenging, hopefully temporary period, that the outcome is going to be much better, both for them, but also for the bank, in terms of that they're not going to have the same losses from those loans. Some of the other things that they can look to do is, what we've seen in the past is allowing people to term out their loans. So if you're, say, down to 20 years or 25 years on a 30-year mortgage, you can term that out to 30 years again, which reduces your repayments. If you're currently paying principal and interest, in some cases the bank might let you switch to interest only for a period, which will again help you meet those repayments. If you do have no choice but to sell, the bank, may be able to kind of help you through that process before, so it's not, not necessarily a forced sale. So I think there are ways to get through this. From the bank perspective, they don't actually want, they don't want to foreclose on homes. That's not a good outcome for them. And so it's in their interest to actually try and keep people in their homes and paying their loans.
And it's quite important to be talking to your bank too, because sometimes when the pressure and the pain comes on, people can get very introverted and just go, the walls are closing in on me. But so important to just open up that dialogue with your bank.
Yeah, absolutely. If people are facing financial difficulties, and economic financial hardship, it's important to kind of, not just your bank, also there are services out there from the government, there are financial counselling agencies. If you address the issues early, it's much easier to get through them. You can start making some changes that will make a real difference in time, whether that's budgeting or potentially consolidating other debts if people have personal or credit card debts, which are obviously much higher interest rates, or even if it comes down to it, looking at potentially selling an asset like an investment property to try and kind of get your position into a better spot. So I think it's really important that people are realistic and look at those options. If rates do go up to 3%, as I think is kind of broadly the expectation at the moment by the end of the year, which means for your average owner-occupier, you're looking at a mortgage rate of around 5.5%. It's to look at your finances and think about, can you afford it, and what changes do you potentially need to make to your lifestyle and to your spending to afford those payments? We're hopeful that, we will be seeing cuts from the RBA at the second half of next year. So it is going to be hopefully a temporary period as long as inflation comes down. The earlier you can realistically assess your situation and start getting some assistance, the better the outcomes are going to be.
Carlos, great to talk to you on this Saturday morning. Plenty of takeaway points, and thanks for coming on to the Real Estate Podcast.
Thanks for having me today.
We connect you to the best real estate information across Australia. The Real Estate Podcast.